Joining me now is Ryan Detrick, Chief Market Strategist at the Carson Group, also the person that sent around these stats about Philadelphia sports teams and the markets, yes. Ryan. So we got a lot of reaction on our internal emails. Let's bring the audience in on this. I'm going to use some air quotes, my man. Research that you did. Yes. What's the thesis here?
Well, first off, good morning, Frank. Thanks for having me in. And I know you're an Eagles fan, so don't get too mad here. There's something called the Super Bowl indicator, right? If the AFC wins or the NFC wins. So historically, there's been 58 Super Bowls. Interestingly, 29 AFC winners, 29 NFC winners. When the AFC wins, stock market's up about 10% on average. When the NFC, I'm sorry, it's with the NFC. When the NFC wins, it's 10% on average. AFC is about 8%. So a little bit better. But the last 13 times the AFC won, Frank, the market's been higher 12 of the last 13 times. So playful stuff, disclosures, don't invest in this. But here's where it gets interesting, like we said with your Eagles. Eagles won, or Eagles, put it this way, the city of brotherly love. When you win a Super Bowl or a World Series, the Athletics won, there was Athletics back then, 1910, 1911 recessions, okay? 1913 led to World War I. 1929, 1930, Philadelphia won again, World Series, not good times. 1980, the Phillies won the World Series, double dip recession. 2008, Philadelphia won World Series. And then 2018, a down year for the market, not that great. Eagles won a Super Bowl. Okay. So listen, maybe, you get it, but just playful way to look at it.
I let you roll this all out. I want to point out something that you forgot. I'm going to go back. Since you're going back to 1910 when the Athletics were in Philadelphia, they're like 3 cities past Philadelphia now.
You're right.
1983, the Sixers win the NBA championship. We're going to show the audience the S&P performance. Up double digits that year. Selective data, Ryan, selective data.
Yeah, I got to admit, it didn't fit the narrative. You're right. It is playful, but we'll see. And I'll tell you this much, Kansas City wins the Super Bowl, market's up like 16% on average versus the one time the Eagles did, it's down. But hey, we'll see. Good luck. I don't like the Chiefs, I'll be honest. So I'm rooting for your Eagles.
Well, I can't tell by the research you did, Ryan, but let's get down to some more serious business.
There you go.
Looking at the markets this week, are you a bit surprised to see some weakness when it comes to big tech? Amazon's the latest, and the markets are still up for the week. Is that a surprise to you at all? And what does that say about investor sentiment and direction of this market?
Yeah, it's a tad surprising, but honestly, when you look at the fourth quarter last year, Frank, we started seeing technology, semiconductor starting to underperform on a relative basis a little bit. So it's not hugely surprising. We came into this year, optimistic, pretty bullish, but more neutral technology. I guess what's really impressive, like 2 Mondays ago, we had DeepSeek Monday. Yeah, the market was down, but you look, 351 stocks were higher, right, in the S&P 500. Well, this rotation is real, right? The lifeblood of a bull market is rotation. I know tech's a huge part of the market. Communication services with Google today is a huge part of the market. But to see, financials hitting all-time highs, you've got industrials hanging in there. Small and mid caps are doing really well. I know they're a dirty word sometimes. So we're really impressed with this rotation we're having. And we think it probably continues as, again, maybe the Fed cuts a little more than the market thinks. Inflation can improve and the economy's strong. We can get into that, but that's how we see it playing out.
Well, Ryan, speaking of the Fed, we have the jobs report coming up later today. The expectation is 169, downward move from last month's or the previous month's report of 256. There are some disruptions in there. There's wildfires. There's some other things going on in this report. How do you think the Fed takes this report in light of some of the policies we're seeing enacted by this administration that they've admitted that they're factoring in? What's the meaning of this report in your mind when we're looking at the Fed? How do you think the Fed's going to take it? And how could it possibly influence the rate cutting cycle?
Yeah, I'm not so sure it's going to influence the rate cutting cycle that much. Like you said, there are some one-offs this month. A couple of months ago, we had obviously the terrible storms that went through the Southeast that really did a number on it. I think inflation is what the Fed really is still focusing on. I mean, you talk about it. I mean, yes, they're worried about the tariffs. They're worried about the policy, but we're not seeing spikes in inflation yet, Frank. We're not seeing big spikes in initial claims. I know a little bit higher yesterday, but all in all, the labor market is still pretty solid. I mean, that's the reality. We're not seeing major layoffs. We're not seeing. We actually saw more people quit last month. I mean, when do people quit? When, you're going to quit if things are okay, right? So, I mean, I know it's not a perfect labor market. There are cracks. I think that's going to matter more. And maybe, over the course of the next quarter or so, we'll get a better clue about the jobs data. But I'll tell you, the economy still looks pretty darn strong to us.
All right, Ryan Detrick, allegedly an Eagles supporter. I can't tell. I just can't tell, Ryan. But always
that's good research, right? You can't tell where I lean. I'm a Bengals fan. Trust me, I have nothing to root for right now. So that's how it goes.